People often assume that options are speculative tools used primarily in Wall Street bet situations to earn ridiculous returns. While I do admit that I myself in the past used to bet aggressively into options that expire in a few days to just a few hours, this is definitely not the agenda of today's video. Instead, what I aim to share with you guys here are practical ways to profit from a bear market using some of my favorite bearish option strategies. If you guys are new to this channel, hello, Darren here. I have been fascinated by options ever since I graduated from university, and I have been investing and trading in options for the last 10 years. Currently, I'm on a mission to share my learnings and mistakes through this YouTube channel, as well as to reach out to like-minded individuals. So if you guys are appreciating this, then please don't forget to drop a like down below, and if you are someone passionate about options, then please do consider subscribing to the channel as well. But before I begin, we always have the usual disclaimers. This video is definitely not financial advice. Option can be extremely risky, and if you're someone very new to options, then please do yourself a favor and learn the basics of options and paper trade first before using your real money to trade. Okay, now that we have gotten that out of the way, let me now share the 3 option techniques to profit in a bear market. And do stay till the end, as I'll be ending this video with a quick and easy way to find bearish stock plays in just 5 minutes. The first way will be to buy a put option. For those of you who are very new to options, the buyer of a put option pays an option premium to enjoy the right, but not the obligation, to sell the underlying stock at a predetermined strike price on or before the option's expiration date. Let us take a look at this SPY put contract right now. As we can see, there is a strike of $375 and the contract matures on the 20th of December 2024. And what this means is that the buyer of this put contract can choose to pay a premium of $4,619.65 to obtain the right to sell 100 shares of the SPY ETF at $375 on or before the 20th of December 2024. So when will the put buyer exercise his right? He'll only do so if the SPY falls below the strike price of $375. It will also be important to note that his break-even for this trade will be the strike, which is $375 minus $46.19, which is the option premium that he has paid, which amounts to $328.81. Hence, if the SPY were to remain above this amount on the expiration date of 20th of December 2024, he will have made a loss. People normally buy puts because firstly, they are either bearish on a particular stock and they just want to profit from a price drop without shorting the stock outright, or secondly, they want to purchase insurance for a stock in the event the stock were to suddenly tank due to negative circumstances such as an interest rate hike, bad earnings, etc. This is known as a protective put, and I will be touching on this strategy at a much deeper level in later videos. What I like most about buying a put contract is that your risk can be easily managed. The maximum loss that you will ever experience when you buy a put is just your upfront option premium. Hence, if the price of the stock were to either stay the same or to rally, the most you will lose is just your pride and the option premium. The next few ways to profit from a bear market involves selling of call options. The call option seller receives premium from the call option buyer and has the obligation to sell the underlying security to the call option buyer at a stipulated strike price on or before a predetermined maturity date. Hence, a call option seller will get to keep the full option premium from the call option buyer when the price of the underlying stock remains below the strike price at option expiration. Okay, now I know what you guys may be thinking. Isn't the selling of call options super risky? The answer is yes. Selling a naked call for a premium will always expose the call seller to unlimited losses. Let us look at an example right now. This is a chart of the SPY. Let us assume that we are bearish on the SPY and we feel that there is no way it will ever reach 400 within the next few weeks. Selling a SPY call that expires in 30 days time with a strike of $400 will net the option seller a premium of $330. What this means is, in the event the SPY remains below $400 at the option expiration date of the 15th of July 2022, the option seller gets to keep the full premium of $330. But if SPY were to rally above $400, then the option seller will have the obligation to buy SPY at the current market price and sell it to the option buyer for $400. Hence, you can see that for a premium of $330, the option seller is exposing himself to unlimited losses, as he will have to buy SPY at whatever price it is traded at the option expiration date just to fulfill his contractual obligation to the option buyer. Hence, a safer way to sell a call option is to sell it when you already have the collateral on hand. Let's say that you already own some SPY shares. If you happen to have just 100 shares on hand and you are short-term bearish on that position, what you can do is to sell a call contract against your position, and this is known as a covered call. Hence, in the event if the stock were to remain below the strike price of the call contract that you sold, you will keep the option premium and rinse and repeat this strategy until A, the trend of the stock turns bullish, or B, the stock gets called away. Therefore, covered calls are a very good way to reduce the cost basis of your current stock holdings. I think it's worth mentioning that there is no perfect option strategy. The covered call is often touted online as the safest way to generate passive income. However, it must be noted that if the stock were to suddenly rally, you'll only earn the premiums collected as well as the difference between the strike and the traded price of your stock. And this actually caps your upside. Let us now discuss the scenario where we do not own any stock. Can we still sell a call to collect premiums and yet cap our losses? The answer to this is yes, we actually can. And in order to implement this strategy, we will first have to identify a stock we feel has a bearish trend, and next, we will identify a price that we feel this stock will never reach at option expiration. We will then sell a call a few strikes above that price, and the last step involves simultaneously buying a call with the same option expiration date above that sold call. The reason for buying this call is because in the event our bearish analyst is wrong and the stock were to actually rally, we will be able to exercise the call that we bought to fulfill our obligation to the buyer of our sold call. This strategy belongs to the credit spread category and is commonly known as a bear call spread. It is a credit spread because we get the credit for opening this position, and in the event the stock remains below our sold call, we get to keep the full credit. Let us use SPY as an example again. Let's assume the same thing, that SPY will not reach $400 within the next 30 days. What we can do is to sell a call that expires in 30 days with a strike of $400 and simultaneously buy a call that expires in 30 days with a strike of $401, as the price of the $401 call is cheaper than that of the $400 call. Hence, opening this option spread will net the option seller a credit of $22 per position. It is $22 because each option contract controls 100 shares, and therefore we will need to multiply the credit of 0.22 with 100. Hence, if the SPY remains below $400 on the 15th of July 2022, the option seller gets to keep the full credit of $22. The amount at risk will be $78, and we get this from subtracting the difference between the strike and premiums that we have received and multiply that by 100. As the difference between the strike is $1 and the premium is 22 cents, hence this works out to be $78. Therefore, in this example, the option seller is risking $78 to earn $22, and that works out to be an expected return of 28% per trade. What I like most about placing credit spreads is that busy individuals like myself with totally no time to monitor the market can just open a spread and let time decay eat into the value of the trade. The seller of this credit spread will always profit from the position as long as SPY remains below $400 at the option expiration. Therefore, if the SPY were to remain within the current market price of $378 at the time of recording this video, the option seller will have pocketed the full option premium. So there you have it guys, my top 3 bearish option strategies to profit in a bear market. Now as a bonus, let me show you how I find bearish trades in just 5 minutes. And to do this, I will need to use my technical screener, Market Club. Market Club is a subscription-based screener that I have been using for a very long time, and it helps investors and traders find bullish and bearish trades fast, as well as provide various entry as well as exit signals. How I would use Market Club in a bear market would be as follows. Once I log into the homepage, the first thing I will do is to click the top option tab over here. This will bring me to this page here where the overall trend of the top 3 markets, namely the Dow Jones Industrial Average, the Nasdaq Composite, and the S&P 500 are flashed prominently, as I firmly believe that the trend is your friend until it ends, of course. Hence, I'll only open a bearish position when all 3 markets are giving me very bearish scores. So, if the 3 major indices are all bearish, then I will click the score button, and this will provide me with bullish as well as bearish plays. As we can see, based on the day that I filmed this video, the number of bearish plays obviously outnumber the number of bullish plays. I will normally treat that as a short-term bearish indicator as well. I have recently done up a video on how I use Market Club to autopilot my trades, and you can find the link here and in the description below for those who want to know more about this screener. And if you enjoyed this video, please give it a like and subscribe to the channel for more options related content. See you!